All right, welcome everybody to today's webinar presentation. Thank you for taking some time out of your day to learn about the duties and responsibilities of a trustee. This is being presented by BECU Trust Services, and presenting will be myself. My name's Mike Teramoto. I'm a senior trust officer. I've been with BECU Trust Services for about 9 years and have 25 years of experience in the trust and investments industry. And joining me as a co-presenter today is...
Hi, my name is Amy Zawilski. I'm a trust officer at BECU Trust Services. I've been with the company just about 4 years now, and I have 15 years of trust and investment experience.
Okay, and let's see, just a housekeeping item. Today's presentation is being recorded. We expect it will be available for playback within the next week or two. It'll be available on the becu.org website. Questions, we encourage questions. Please use the chat feature that's found on your screen to enter any questions that you may have during the presentation. We will plan to leave some time at the end of the presentation to answer those questions. You can see our contact information is showing up on the screen that's being presented. You're welcome to call us at BECU Trust Services with the phone number, or you're also welcome to send emails directly to Amy or myself. Just a quick disclaimer regarding today's presentation. BECU Trust Services and the presenters, Amy and myself, we are not attorneys. This presentation is not legal advice and is intended for general information only. And with that, let's get started.
Okay, so just to give you a brief overview of some of the topics we're going to discuss today, we are going to talk about what is a trust, who are the participants in the trust, how do you name a trustee, what are some of the duties and responsibilities of a trustee, what are the different roles that a trustee can have, and what are the major differences between corporate trustees and individual trustees.
Perfect. So before we can talk about really the roles and responsibilities of a trustee, we need to make sure everybody is aware of what is a trust, right? A trust is simply just an arrangement in which one party gives a second party the right to hold title to property, to stuff, to assets, right? For the benefit of a third party. Okay. This arrangement, it's most often written as one of two ways is really most common. It can be a revocable living trust document, something that's written currently, right? Revocable living trusts are used for estate planning, incapacity planning, for privacy reasons, for tax planning reasons, many other reasons why somebody might have a revocable living trust, otherwise known as a living trust or a revocable trust. The other common arrangement where you'll see a trust is in somebody's last will and testament, right? Otherwise known as just a will. Instead of leaving assets outright to a beneficiary, which is most common when people think of inheriting assets from a will, the testator, the person that writes the will, can choose to leave assets in a trust for their beneficiaries instead of giving them outright control over those assets, right? There's lots of good reasons why somebody may create a trust. Maybe it's for a minor, somebody that's under the age of 18. In that particular case, if a minor were to inherit assets without a trust, a guardian would need to be appointed, and that guardian would be responsible for managing those assets until that minor turns 18. By creating a trust, it allows the testator, the person creating the trust, to create the rules and restrictions on how that trust is to be managed until that minor reaches whatever age that might be appropriate for that beneficiary to receive the assets outright. Maybe a beneficiary is less than responsible as a result of drugs or alcohol, or maybe just financially irresponsible. Another very common reason why trusts are created. maybe there's a spouse and there are significant estate tax planning opportunities by creating a trust as part of a will or part of a revocable living trust. Especially here in the state of Washington, estate taxes can apply to estates that are over $2 million. And so for couples that have estates that are larger than that, there can be some significant estate tax planning opportunities. If a beneficiary has special needs, that means they're qualifying for government assistance programs, right? Housing, maybe supplemental security income. If a beneficiary were to inherit assets outright, that could potentially disqualify them from being eligible to receive those government benefits. That would be another perfect reason for having a trust. Maybe for those of you that have children, how many of you are happy with the spousal choices that your children have made? You may or may not be happy with them, but just know that in the event that your child inherits assets from you and then later gets a divorce, their ex-spouse could walk away with potentially half of the inheritance that you have left for your child. So again, creating a trust for your child could protect those assets from a possible future divorce that your child may have. So lots of good reasons for having a trust. And we'll move on to who the participants are in a trust.
Yeah, so let's talk a little bit about the participants. The participants in a trust are the trustor or grantor. This is the person that creates and opens the trust. The trustee is the individual, or it can be an organization, that administers the property in the trust. And the beneficiary is the person that is designated to receive the benefits from the trust. So if we think of a trust as a box, the trustor is the person who creates the box and puts contents in it. The trustee is the person responsible for managing all of the contents in the box, including investments, distributing, administration of the trust. They have to protect it. Then the beneficiary is the person that receives the benefits from the contents of the box. For most revocable living trusts, that can be the same person in all three roles to start out with. So the trustor is the person who creates the trust for their benefit. They would be the trustee administering their trust, and there also would be the beneficiary who is reaping the benefits of the trust. And as the trustor ages or becomes incapacitated or passes away, that trust may then transition to a successor trustee. And as the beneficiary ages or passes away, the beneficiary of the trust could transfer to a remainder or future beneficiary. And all of this will be laid out in the trust document. It will name the successor trustees and the remainder future beneficiaries. So how do you name a trustee?
So naming a trustee, it's going to be in the trust document, right? So whether that's a will that creates the trust within the terms of that will, would create the trust and would name the trustee, or whether it's in a revocable living trust document, again, would identify who the trustee is. Those documents, whether it's a will or a trust, also will indicate a successor trustee, right? Who's going to take over in the event that trustee is no longer able to serve. In cases where the document doesn't clearly identify who a successor trustee is, or in some cases, a court may create a trust itself, that the trustee can be appointed by the courts. Okay.
So there are many duties of a trustee, and we can't cover all of them today, but some of the most essential duties are listed on this slide here. The most important duty is to make sure you understand and follow the terms of the document. All trusts are not created the same. They're all very different. They're very flexible. So as trustee, you need to understand your role and what is being asked of you. You also need to understand the trustor's intent and what they were trying to accomplish with this document. You have a fiduciary obligation to the trustor and the beneficiaries to make sure that you are administering the document properly. Sometimes there can be questions about the trustor's intent, but you could always petition the court for instructions to make sure you're interpreting the document as it was meant to be interpreted. And the trustee does have a legal liability if they are found that they're not following the terms of the trust correctly.
Yeah, that's right. The beneficiary, if for whatever reason they believe that the trustee isn't following the terms of that particular trust, the beneficiary can initiate legal proceedings against that trustee to basically sue the trustee or force the trustee to follow the terms of whatever that document may say. Another duty of the trustee is to exercise the power wisely and prudently, right? A trustee is not all powerful. They can't just do whatever they want. They need to use sound decision making in all aspects of administering the trust. When hiring professionals, making investment decisions, when making distributions, right? A trustee sometimes doesn't have all the skills that are necessary to administer a trust, whether it's preparing taxes, filing court accountings, making distributions, managing the assets, right? Hiring professionals is typically going to be a prudent thing to do for roles that the trustee is not experienced with or comfortable doing themselves. When hiring professionals, it's typically going to be prudent to consider more than just one professional regarding their services. If they need to hire an investment advisor, getting proposals from 2 or 3 different investment advisors, understanding their skills, their experience, their fees, how they would manage the assets typically would be a prudent and wise thing to do. When administering a trust, a trustee, as part of exercising their power wisely and prudently, needs to consider that aspect when retaining assets, in decisions to sell assets, just ongoing management of assets, including negotiating or settling any claims that the trust may have against others, right? Collecting debts that are owed, borrowing or lending funds. One of the things that they need to do when they're exercising this power is ensuring that they're removing any personal biases that the trustee may have. Really consider the terms of the trust, the trustor, the trust, and the trust beneficiaries. The trustee may have a bias against buying new cars. The trust beneficiary may want a new car. The trustee really needs to consider the situation, the beneficiary's needs, situation, and the circumstances revolving around the trust to determine what might be appropriate to do. Yeah, in one particular example, a trust beneficiary was turning 16. Of course, what trust beneficiary that's turning 16 doesn't need or want a car, right? In this particular case, the request was for a luxury car, right? A Lexus. In evaluating that request from the beneficiary, the trustee really took a look at and examined the facts and circumstances of that request. In this case, the family always had purchased brand new luxury cars in the past, and so that was a normal expectation for that family in terms of the vehicles that they always drove. The trust in this particular case had enough assets, more than enough to make a purchase of a luxury car. And so in this case, it was approved. But that wouldn't always be the case of every particular trust. And really just it's a good example of just being prudent and wise in exercising the power of the trustee.
And a trustee also has a financial duty to the beneficiaries. They need to provide distributions to the beneficiary per the terms of the trust. They need to understand the beneficiary's needs, both current and future needs. Sometimes that includes assisting the beneficiaries with budgeting and helping them understand how the trust can provide for them throughout their life. The trustee also needs to, when applicable, make distributions directly to service providers for the benefit of the beneficiary. And this is especially important when a beneficiary has a special needs trust. Giving them money directly could jeopardize some of the government benefits that they're currently receiving.
Yeah, and in one particular case, there's a beneficiary that where the trust was providing distributions to the beneficiary for her to make her health insurance monthly premium payments. We found out that the beneficiary, in fact, was taking those distributions from the trust and was not using them, those funds, to pay for her monthly insurance premiums, but instead was apparently using that cash to supplement her drug and alcohol addiction needs. So in this particular case, trustee needing to ensure that that beneficiary maintained her health insurance, because that's vitally important for her ongoing health and benefit needs. A determination was made that those health insurance premiums would in fact be paid directly to the health insurance company to ensure that the funds intended for health insurance was used appropriately. So another key duty of a trustee is to distribute assets upon termination, right? That could include a partial early distribution. Sometimes that's appropriate depending on the facts and circumstances of the particular trust. When making any distributions, the trustee is responsible for ensuring that all administrative issues are wrapped up. That typically can include filing of tax returns, may include court approvals, court filings, court accountings. Could just making sure all the final bills of a particular trust are covered. In the event that a trustee makes distributions, final distributions, pays out all the assets to beneficiaries, and then finds out there's some bills that didn't get paid, it could be the trustee's liability to ensure that those bills get paid if the trustee's not able to reclaim some of those earlier distributions that may have been made to beneficiaries. As it relates to distribution of assets upon termination, one aspect that a trustee can consider is at what point does a trust really become insufficient to implement the terms of a trust. Here in the state of Washington, we have some guidance that is codified in the RCWs, that's the Revised Code of Washington. Chapter 18 of those regulations are related to probate and trust law. There's a particular section within Chapter 11. It's 11.98.070.32. You don't need to remember that. But that particular section deals with trustee powers and says that if the value of a trust is insufficient to implement the intent of the trust, then the trustee can choose to terminate that trust by making distributions of remaining assets to the current beneficiaries. In this particular case, a trust was less than $100,000. The beneficiary had some upcoming needs for some distributions from the trust, and when a trust really gets below a certain value, it really is inherent in the trustee to evaluate whether it makes sense to have that trust ongoing. The cost for administering that trust, for preparing tax returns, for engaging the services of an attorney, any other professional services that might be needed can really create a situation where that trust is depleting faster than it really is appropriate. So in this particular case, the trustee does have that discretion to terminate a trust. So just one example of a situation where a trustee has some guidance, needs to be aware of what the rules are in their particular state, and use that responsibility accordingly to make prudent decisions.
So let's move on to the responsibilities of a trustee. One of the responsibilities of a trustee is proper funding of assets. So making sure that the trust is funded with the proper assets that need to be included in it. This is especially important for revocable living trusts. We've seen situations where people spend a great deal of time and money in creating this trust and then never get around to transferring the assets into the name of the trust. So you have your really nice fancy box, but you never put anything in it. So the trust is empty. It's the trustee's duty to make sure that assets coming from an estate are received and everything that was entitled to go into that trust go into the trust. So it's double checking the documents and making sure that everything that's listed in the document actually gets put into the trust to fund it. And Mike has a great example of this.
Yeah, just real important for the trustee to take a look at the assets that are funding the trust and making sure that everything's there that's supposed to be there. In this particular case, a parent died, leaving all of his assets into trust for the benefit of his teenage children. In this particular case, his parents, the grandparents, were named as executors of their son's estate. Right, they were responsible for paying all the final bills, his medical expenses, gathering up all of his assets, and then distributing those assets into to the trustee for the resulting trust for the grandchildren. In this particular case, one of the assets that the son owned was a townhouse, and these particular grandparents liked the townhouse, decided to sell that townhouse to themselves. Well, that could be fine, but as the trustee, when we took a look at the actions that these executors did in their son's estate, it was believed that the transaction to sell that townhouse to themselves as executors of the estate really was done at a value significantly below the market value, true market value of that townhouse. So as the trustee of the resulting trust for the grandchildren, we initiated an action to pursue really getting a true value for that townhome. There was additional assets that were received from the grandparents to provide for the sale of that townhome at what was to be a true market value. So just an example where it's really the trustee's responsibility not just to manage what's there in the trust, but to make sure that everything is there that is supposed to be there. Another responsibility of a trustee, making proper distributions to the beneficiaries, right? Handling trust income in accordance with a document. In many trust documents, there's instructions on what the trustee is to do with income. Typically, or often is the case, where that trustee is responsible for paying out the income to a beneficiary, whether that's monthly, quarterly, or annually, whatever the case might be. Sometimes the discretion to pay out income is given to the trustee, and that income can be retained in the trust. So it really depends on the trust document. Improper handling of that income, again, can result in legal action being taken by the beneficiaries, right? If income is being paid out more so than it should be, remainder beneficiaries may be concerned. If not enough income is being paid out, current income beneficiaries may have a concern. So that's just where a trustee needs to make sure that they understand the terms of that particular trust document and are following in accordance with those terms. Sometimes a trust may have more than one beneficiary, right? In that case, again, the trustee needs to look at the terms of the particular trust and determine whether all the beneficiaries need to be treated the same when it comes to distributions, or whether the trustee can use discretion. And in that case, the trustee must act impartially in administering the trust and making distribution decisions. Just wanted to point out that a few small word changes can make significant differences in how a trust is administered. Great example is the words shall and may, right? If a trustee shall make distributions, that's basically something that they are mandated to do. For instance, a trustee shall distribute all income. That's pretty clear. Then the trustee needs to make sure that the income is being distributed, versus language that may say a trustee may distribute income. Well, the word may means that the trustee has that discretion, can make those decisions to distribute income or not. So oftentimes a beneficiary may see in a document that the trustee may distribute income, and a beneficiary may interpret that to mean that, see, they're entitled to the income from the trust. Well, no, not necessarily the case. A good example of that particular situation is a trust. Trust may indicate that 10 years after the death of the trustor, that the trust is to distribute to the beneficiary, right? The trust document in this particular case, although it had that language, there was additional language that indicated that the trustee had the discretion to withhold a distribution if the trustee felt that the beneficiary may not be able to manage those funds appropriately. So again, a situation where a beneficiary may believe that they're entitled to a distribution, the trustee may or may not make that distribution using their discretion based on what the trustee believes to be proper and appropriate based on the terms of that particular trust.
Another duty of a trustee is reporting. A trustee is responsible for providing proper and timely notice of the existence of the trust to current and future beneficiaries, and this is in accordance with the state laws of the state that governs the trust. Depending on what the document requires, accurate and timely reporting of trust activities, including disbursements and expenses, and trust assets to beneficiaries and possibly remainder beneficiaries, can be included. Comprehensive trust accounting reports or Excel spreadsheets combined with bank account statements and investment statements, all of that can be used in combination to provide the reports to the beneficiaries. And this report can have information like what are the assets in the account, what are the transactions, is the money going to income versus principal, and all of this is available for the beneficiaries. And depending on the trust documents, it can also be available to any future beneficiaries or remainder beneficiaries.
Another huge responsibility of a trustee is the taxation matters, right? Trust income taxation can be much more complex than just standard individual income taxes, as if individual taxes aren't complicated enough. So trustees have the responsibility to separate income from principal, track expenses, make decisions appropriately to minimize tax liabilities where possible, right? Trusts have significantly higher income tax rates than individuals do, and those tax rates kick in at a much lower level. In general, net income in a trust that exceeds $11,000 can likely be subject to the highest tax rates that exist. So right now, that's 37%. Individuals that typically that highest tax rate won't kick in until hundreds of thousands of income. trustee is also responsible for filing tax returns as appropriate, right? That's all types of tax returns, income tax returns, estate tax returns, can also include payroll tax returns, real estate property tax payments, all types of taxation. In certain cases, a trustee might also have a responsibility to file tax returns for a decedent, right? So taxation, definitely a matter that a trustee needs to be aware of and following the right procedures. In the situation where a trust is created as a result of a person's death, doing cost basis adjustments might be appropriate, right? The cost basis adjustment is something where at the time of a person's death, assets are entitled to a step up in basis to the market value of those assets at the date of the decedent's death. Okay, so that anybody inheriting those assets subsequently would not have to pay capital gains taxes on the value of that increased while the decedent held on to those assets. That can result in some significant tax savings. There's one particular story that comes to mind. In this case, a parent died, named her sister as the trustee of trust for this parent's 3 young adult children. The aunt, wanting to do a good job, having good intentions, set up the 3 separate trusts for her nieces and nephews, administered those trusts. At some point, the aunt, due to her declining health, was looking to name a successor trustee, somebody to take over the administration of those trusts. In evaluating the situation, it was determined that while the trusts were created and the assets were being managed, trust tax returns had never been filed on those particular trusts. Instead, what was happening is that the income, gains, and losses, all of the tax information for those trusts was being passed through just on 1099s to the beneficiaries themselves and was being included on their 1040 tax returns instead of each of those trusts filing a Form 1041, a trust income tax return. So trying to go back and hire professionals to basically recreate history, going back, ensuring that the appropriate tax returns were compiled and filed, just was a big mess. So great story where person takes over as trustee, great intentions, trying to do the right thing, ends up just creating a big problem. So taxation, important matter for a trustee to consider.
And a trustee also has a fiduciary duty to always do what's in the best interest of their beneficiaries. And this is based on the terms outlined in the trust. This includes being aware of and complying with any state laws, which here in Washington, as Mike already referenced, is Chapter 11.98 of the Revised Code of Washington. Trustees need to avoid conflicts of interest, not commingle funds, and avoid self-dealing. That's when the fiduciaries are acting in their best interest rather than the best interest of the beneficiaries. The trustee must consider the needs of both current and remainder beneficiaries based on the terms of the document. And all distributions don't need to be equal, but again, that will all be outlined in the document.
Okay, one of the biggest responsibilities, as if all of these things aren't big, is investment management of the assets that are in the trust, right? A trustee has that responsibility to really manage those assets as a prudent investor would by considering the purposes of the trust, the terms, distribution requirements, and other circumstances, right? It doesn't mean that in the management of the trust that the trustee must avoid investment losses. No, definitely not the case. Okay, simply means that a trustee must be managing those assets prudently, as a prudent investor would. Okay, it means avoiding undue risk. It probably would not be appropriate for the trustee to invest 100% of the trust assets in Bitcoin. The trustee may love Bitcoin. Who doesn't when the value of Bitcoin is increasing into the thousands of dollars per coin, but that likely would be deemed not to be a prudent investment. Definitely, if 100% of the trust were invested in that way, that's in conflict with the responsibilities to properly diversify a trust in its investments as part of the investment management responsibilities. Okay, a trustee, if they don't have the ability, skills, and knowledge to manage assets directly, they definitely can have the ability to engage the services of an investment professional. Okay, whether that's managing marketable securities, managing real property, or possibly managing a closely held business, right? Engaging the services of an appropriate professional, whether it's an individual or company, to manage that particular asset or assets of the trust. Very important. As part of managing assets, it's very important. One aspect is to ensure that the proper insurance is maintained on those assets. There's the story where a trustee was managing a home. The homeowner's insurance lapsed. The home was being used by some beneficiaries. There ended up being a water leak. Water leak created a lot of damage to the home, and found out the insurance on that home had lapsed. Big problem for that trustee, where again, they potentially could be held personally liable for their responsibility in not ensuring that the property was properly insured. Okay.
So the roles of a trustee. Irregardless of if the trustee is serving as sole trustee or co-trustee, they are collectively responsible for all the duties and responsibilities of a trustee. So a trustee may act as a sole trustee where they're an individual. They can be a professional trustee or family member, friend, corporate trustee. They have all the responsibilities of the trustee. There are co-trustees where two or more people work collectively together and administer the trust. Hopefully the trust document has some language in it as to how the trust is administered if the trustees don't agree. Generally, there's some guidance in there on how the decisions need to be made. Do they need to be unanimous? Does one trustee have the right to make decisions over the other? That should hopefully all be outlined in the document. A successor trustee is the person who's kind of waiting in the wings. They're not trustee right now, but they're next in line, and they have no responsibility until they accept the role of trustee. So they're just kind of waiting off to the sides. The agent, a trustee may be named and feel that they need to serve, but they may not have the expertise or the desire or the time to put all of the work in that is needed as trustee. And in that case, they can consider hiring a corporate trustee to act as agent. And that agent does the behind the scenes work for the trustee on behalf of the trustee. Investment management, administration, the day-to-day work that needs to be done to assist the trustee. So now let's talk a little bit about the differences between individual trustees and corporate trustees.
Yeah, so as Amy mentioned, oftentimes when people are thinking of creating a trust, they likely will look to family members to consider who the appropriate trustee may be. Well, naming a family member as trustee of the trust might be appropriate in some cases, but there definitely could be situations where naming an individual, whether that's a family member or friend, could possibly not be the right choice. And we're just going to go over some of the differences and considerations in naming an individual trustee versus a corporate trustee, right? Starting off with expertise. Most individuals lack experience in being a trustee. It's not something that's common for people to serve in, right? Versus a corporate trustee, they typically have teams of experienced professionals. That's what they do. They have access to efficient tools for the administration and reporting of trusts. Another consideration is the future ability to serve as a trustee, right? Individuals, they could get sick, they could pass away, they could move away. There's lots of reasons that an individual may, in the future, not have the time or ability to serve as a trustee of the trust that you're creating. A corporate trustee, typically, they are going to be around perpetually, right? The existing trust officer or trust officers may move on, may retire, but a corporate trustee will always have a team of trust officers, and that will be there ready to serve when the time comes for their need. Okay, impartiality, right? The individuals, if you're naming a family member, it may be difficult for that family member individual trustee to say no to a beneficiary's request. That might make enjoying the next upcoming family holiday gathering a bit challenging for that trustee and beneficiary to enjoy. A corporate trustee, on the other hand, doesn't have to worry about their decisions and the ongoing impacts that it may have to family dynamics, right? A corporate trustee is not going to be impacted by having to worry about what the dynamics are going to be at the upcoming family gathering. Okay, time availability, another big concern. Individuals may not always have the time. They might have their own full-time job, they might have a family, they might have other commitments. Corporate trustee, that is their job, okay? That's what they get paid to do and typically have the time available to serve in that responsibility. For regulatory oversight, typically individuals, there is none, right? Whereas a corporate trustee typically is regulated by the state or federal government and may also have some internal auditors to monitor the provision of their services. Liability, again, another significant concern. Individuals oftentimes will not have any insurance to cover the losses that may result from a mistake or error that an individual trustee may make. Versus a corporate trustee typically will be required to have and maintain appropriate insurance. But before that, corporate trustees typically are going to have policies and procedures and expertise that will limit the mistakes that they may make. When and if a mistake is made, insurance is going to be in place to cover that potential loss. And finally, cost and efficiency, right? An individual, they may or may not charge fees, which every situation might be a little different. But that individual, if they're named as a trustee, because they don't necessarily have the expertise, the individual trustee may incur higher professional expenses, hiring an accountant, hiring legal attorney services to give them the guidance needed. Attorneys typically charge high hourly rates, and if an individual trustee doesn't have any experience and needs to rely on the guidance of an estate planning attorney, a trust attorney for a lot of the services that they provide can be relatively expensive. Corporate trustees, yes, they charge fees, but because of their efficiencies, it may result in a timelier administration and typically will have lower costs to engage other professionals. So just some great considerations in terms of when a decision is being made, who to name as a trustee. Do you name an individual, friend, a family member, or maybe consider the services of a corporate trustee.
And a little bit about BECU Trust Services. We are a full-service corporate fiduciary. We have a local team of 6 trust officers. We can serve as trustees, co-trustees, or agent for individual who is serving as a trustee. We can be also named as a successor trustee in a document. We are part of Members Trust Company, a federally regulated thrift that provides trust and investment services to credit union members nationwide. And we would be happy to speak with any of you regarding your situations and to learn how we might be able to assist you or loved ones. So we have a few minutes left in the presentation. I see a few questions in queue already. If you have any questions you would like to ask, please feel free to type it into the chat box or raise your hand, and I can try to unmute you. You may be asked for an audio code if you would like to speak, but let's take a look at some of the questions we have here. Let's see, Mike, do you want to answer this one? The question is, can a trustee hold liquid assets in an interest-bearing account in their name, then keep the interest for themselves when the distribution is made to the beneficiary?
Wow, you know what? Well, a trustee can do a lot of different things, but is that the right thing to do? And is that appropriate and proper? No, any assets that a trustee is holding on behalf of the trust should always be held in the name of the trust, right? Interest that is earned on those particular assets is typically interest that's going to belong to the beneficiaries and would not belong to the trustee. Now, a trustee can charge fees, and that's typically an appropriate way for a trustee to be compensated for the time and effort that they put in. But interest earned on an interest-bearing account for trust-held assets probably is not appropriate for those assets to be in an account that's in the name, direct name of the trustee.
Great, thank you. Another question here is, what happens if there are co-trustees and they do not agree on a distribution? So hopefully there's language. Go ahead, Mike.
Well, I was just going to say, it really depends on the terms of the particular document. A well-written trust document that anticipates or has the existence of co-trustees should clearly indicate how co-trustee decisions are to be made. And if there is disagreement among co-trustees, how a decision is handled, because clearly you don't want to have a situation where there are 2 co-trustees, they disagree, and that just causes inaction, nothing to happen. That would be a bad situation. So always look to the trust document. If the trust document doesn't provide instructions for how a co-trustee disagreement is to be handled, the co-trustees can always petition the court to provide a direction as far as how to proceed.
Great, let's see. I see Kelly has their hand up. I'm going to unmute you, Kelly. If you wanted to ask your question, please go ahead.
Hi, can you hear me?
Yes.
Oh, good, thank you. I have a couple questions. My husband and I are trustees, and for one beneficiary, and so I'm looking for software recommendations. Does BECU administer end fund trust or just administer?
Did we lose her?
Kelly, are you there?
Yeah, does BECU?
There you are.
Does BECU administer and fund, or just administer, or do both?
Sure, I can take that. So in terms of administering a trust, yes, that's one of the primary reasons for our existence. When you talk about funding a trust, the assets are coming from somewhere. Is that from an estate that the assets are coming from, or when you're
Yes.
talking about funding, I guess I'm a little unclear.
Yes. Do you actually do the investment part? Because if the funds went into BECU, you handle that, or do you just handle the administering part?
Yeah, here at BECU Trust Services, we are full service corporate trustees. So we do take on the responsibility for managing assets that are in a trust for which we happen to be trustee and are responsible for. Not all corporate trustees are the same, right? Some corporate trustees will administer the trust while hiring the services of an investment advisor to manage the actual investments. But yeah, here at BECU Trust Services, we administer and manage assets for which we are responsible.
Okay, so if my funds were in a different institution, then you wouldn't be able to give. I couldn't use your services then. Is that correct?
Well, to the extent that we become a successor trustee, because I'm just going to assume that maybe you're the current trustee, right?
Yes.
And while you're able and willing, you manage those assets. They could be spread out in various financial institutions, right? Including banks, investment advisors, or maybe just brokerage firms. But at the point in time where we need to step in as a successor trustee, okay, basically upon your incapacity or your death, then we would actually make the effort to consolidate all of those assets into our custody so that we have control and can manage those assets. We believe as a trustee, it's our responsibility to take control to ensure that those assets are secure, and then using our in-house investment team manage those assets appropriate based on the terms and situation, facts, and circumstances of your particular trust and the needs of that beneficiary.
Okay. Okay. And is a beneficiary, is it proper for them to speak with the investment company or the trust company?
Yes,
Yeah,
we deal
absolutely.
directly with beneficiaries all the time.
Okay. Okay. So yeah, I'm a brand new trustee, so that's why I'm, asking these questions. So thank you.
Yeah, you're welcome.
A beneficiary, you definitely need to have that line of communication open, but ultimately it is the trustee's responsibility when making investment decisions. Okay, so a beneficiary may want a trustee to invest 100% in Bitcoin. As a trustee, that's probably not something you would want to do.
Right. Okay, thank you.
Okay, great. Yeah, you're welcome.
Okay, Jane, I see your hand up and a question in the chat box. So I'm gonna unmute you. I don't know if you would like to ask your question verbally or not, but go ahead if you'd like to.
Yes,
ask your question.
I would like to. I think it would be faster than me trying to type again. So
okay.
I was the one that asked the question about the interest-bearing account, the trustee opening up a business or an interest-bearing account for liquid assets, mainly cash, and then in an interest-bearing account in their name and then of course distributing only what was there, the initial cash, and keeping the interest that was accrued. So Mike said it would be proper, and based on the principle of the thing, the trustee would distribute whatever was made in interest along with the liquid cash. Correct, Mike? Wasn't that what you said?
Well, yeah, to start off, a trustee shouldn't be holding trust assets in an account that's in the individual name of the trustee,
Okay.
right? That's commingling
Okay.
trust assets with their own assets. But
Well, what if
yeah,
they
if
opened a
trust assets,
separate account in their name with only that dollar amount in there? Regardless, it would be accruing interest. I mean, the smart move, it would be in an interest-bearing account, right?
yeah, so I don't want to get into too much specifics on one situation, but in general, a trustee should not be putting trust assets into an account that's in their individual name. That's
Okay, but if
commingling
they
their
did,
trust assets with.
but if they did,
In
they
general,
should be
assets of
splitting
a
up the
trust.
interest to the beneficiaries, correct? They should be distributing whatever's accrued in that interest-bearing account out to the beneficiaries because it was a trust account. It's a trust asset, correct?
Uh, yeah, in general, if assets of a trust are generating income, that income is an asset of the trust and should be handled in accordance with the terms of the document.
Okay, very good. I just was asking for
Mhm.
clarification of that.
Mhm.
Now, my second question up there is because you had said that the trustee was able to charge fees towards, charge the beneficiaries fees for services. And my question is, what kind of, could you give some examples of what, because it's not a corporate trustee. I know you covered both corporate, and what was the other one?
Yeah,
It was
so
two
again, it
different
depends on,
categories of trustee.
corporate trustees versus individuals named as a trustee.
Right, and that's right, and it's not a corporate trustee; it's an individual trustee. As a matter of fact, the trustee is a beneficiary as well.
Mm-hmm. Yeah, so fees can definitely be charged by a trustee. You need to look at the particular terms of the document. The document may provide guidance, right, in terms of how fees are to be charged. So that's the first place to look. Okay, if it's not indicated here in the state of Washington under the Trust Act, I believe it does say that trustees can charge fees. An individual that doesn't do it as their profession, they need to make a decision as far as what's fair and appropriate. In the end, that might be subject to a court's interpretation if the fees that are charged, if a beneficiary or somebody else might disagree. But again, that's as a corporate trustee, we have a fee schedule that we use to charge fees. How much an individual may charge really is I think subject to a lot of interpretation. So I wouldn't be
Okay,
able to give a specific dollar amount that an individual trustee.
right.
I'd suggest you consult with a trust and estate attorney regarding that question.
And I wasn't asking for a specific amount. I was asking for examples of the kinds of fees that they would be able to charge. I mean, what would they
Yeah,
be
an
charging
hourly
fees for?
fee could be appropriate.
Oh, okay, okay.
Could be.
And then my last,
Definitely being reimbursed for any expenses that they incur is generally, I think, an appropriate expense. Right.
okay. And
But
then
in
if
terms
there's
of,
no expenses that they would incur, there would be no fees, obviously, unless they're charging hourly rate for their services as a professional trustee, but they're not a professional trustee. They were just appointed in the trust to be a trustee.
yeah, so the
So,
document or state law may allow that individual to charge fees, even as an individual, if they're not a professional, and
Okay.
how much they should charge if the trustee is uncertain. Yeah, recommend to consult with a trust and estate attorney for some guidance as far as what might be appropriate.
Okay, I get it. Okay, and then my last question
Mhm.
was, if the trust is dissolved prior to a sale of an asset, for example, like the sale of a home that was, the home was left by, say, a parent to the beneficiaries who were their children, does the trustee, have the same power during and through the duration of the sale if the trust was dissolved prior to the sale of the home?
So once a trust is dissolved, a trustee doesn't have any more responsibility, right? So in that particular case, if the trust was dissolved prior to a sale of a trust asset, well, what happened to that trust asset? Was it still in the name of the trust? If so, then it's likely the trust wasn't dissolved, or maybe that trust asset was distributed in kind, right? The property itself was distributed to the beneficiaries, and then the beneficiaries end up selling it. But again, if a
Yeah,
trust still has assets, it's probably not appropriate to dissolve the trust until all of the assets are properly distributed.
right. Okay, very good. Thank you.
Okay, and whether that's real property or whether that's cash, right? So whatever the case may be.
Okay,
Well, great.
thank you.
So you're welcome. It looks like we are at
So
our time. Go ahead, Amy.
yes, I was just going to say, to be mindful of everyone's time, we just want to go ahead and wrap this up. I put up a slide here with our email and our phone number. So if you have any additional questions that we didn't get to today or think of something later, feel free to reach out to us and we're happy to answer that question for you. And just as a reminder, this presentation is being recorded and is expected to be available within a couple of weeks on the becu.org website. You should also be receiving a copy of this presentation via email from Members Trust Company. It will include a link for you to provide any questions or comments regarding our presentation. And like I said earlier, feel free to reach out to any of us directly with questions. And we hope you enjoyed today's presentation. Please visit becu.org to learn more about future webinars and our services. And thank you very much for attending.